Welcome back to Intelligent Investment Today, a podcast concerned with all things value investing. In each episode, we take a different topic from the investment landscape and attempt to apply the lessons as laid down by its founding father, Benjamin Graham. In this episode, we're going to take a look at another interesting idea and throw at it all the principles of the craft to see which of them stick. Specifically, we'll be exploring how value investing applies not only to listed businesses, but to private businesses as well. It is often forgotten that even the largest multi-billion-dollar behemoth is, at its core, a business like any other. No different in principle from your local mom-and-pop store. The principles of valuation remain exactly the same, and they can be boiled down to three core ideas: what a business earns, what assets it owns, and the qualities it possesses that allow it to remain a going concern into the future. This episode is intended as a reminder to the value investor not to get swept up in the hype and the complications of modern stock markets, and to remember that a business is a business, whether it turns over just a few $100,000 or a few $100 billion. Forget EBITDA, or bullshit earnings, as Charlie Munger used to call them, and value a listed company exactly as you would if you were considering the purchase of your local independent grocery store. So, without further ado, let's crack on. As ever, sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. Most people think that value investing belongs on Wall Street. They picture stock tickers, balance sheets, and annual reports. But Benjamin Graham never said that value investing was all about stocks. He said it was about the intelligent allocation of capital. Stocks were simply one place where that discipline could be applied. So today, imagine something different. Imagine Benjamin Graham's most famous disciple and the world's most successful value investor, Warren Buffett, walking down a quiet neighbourhood street. No trading screens, no analysts, just a small independent grocery store, with a handwritten sign taped to the window, "Business for sale." How would he, as a value investor, approach this opportunity? Not with excitement, not with dreams of expansion, and certainly not with optimism disguised as analysis. A value investor would begin with skepticism. The very first question would not be how much money could be made if everything went right. Buffett would consider that to be speculation. Instead, the first question would be how much could be lost if things went wrong. That question comes before any discussion of upside, because protecting capital is the foundation of intelligent investing. Before even stepping inside the store, a value investor would already be thinking about risk. What could realistically threaten this business? Is the neighbourhood declining or improving? Is foot traffic stable or shrinking? Could a larger supermarket open nearby and change the economics overnight? Is the store dependent on a single supplier or distributor? Is there something fragile here that could break suddenly and without warning? This mirrors how Buffett evaluates stocks. He does not begin with rosy forecasts. He begins by asking whether an investment could permanently impair capital. Applied to a small grocery store, that mindset becomes very practical. Could this business go to zero? Could profits disappear suddenly? Could external forces overwhelm even a competent management? If the downside risk looks severe and uncontrollable, the analysis ends there. No amount of projected growth compensates for a weak foundation. If the business passes that initial skepticism, only then does the value investor step inside. One of the next things a Buffett-style investor would focus on is the relationship between the business and the owner. This is a critical distinction that Buffett learned early on and never forgot. Many small businesses are not systems. They are extensions of a single person's effort, relationships, and intuition. And so the value investor observes quietly. Does the owner work constantly? Do they personally negotiate with suppliers? Do they handle pricing, staffing, inventory selection, and bookkeeping themselves? Are customers loyal to the store or loyal to the owner? If the owner disappeared tomorrow, would the grocery store still function? If the answer is no, then what is being sold is not really a business. It is a job bundled with inventory and equipment. Buffett would be deeply suspicious of that. A true investment should not require heroic effort to survive. It should function reasonably well under average management. As the investor Peter Lynch once said, go for a business that any idiot can run, because sooner or later any idiot probably is going to run it. A real business has processes, repeat customers, and operations that can be delegated. It may not be glamorous, but it does not collapse without one person holding everything together. Once the business has been separated from the personality of the owner, the value investor then turns to cash flow. And this is where Buffett's discipline becomes uncomfortable for many would-be buyers. The question is not how much revenue the store generates, or how busy it looks during peak hours. The question is how much cash the business reliably produces for its owner, after all expenses, year after year. That means accounting for rent or mortgage payments, utilities, inventory replenishment, employee wages, maintenance, insurance and taxes. It also means subtracting a realistic salary for the management, even if the buyer plans to run the store themselves. And this is perhaps one of the hardest mental shifts for people buying small businesses. They assume that their own labour is free. Buffett would reject that idea immediately. If a business only looks attractive because the owner is underpaying themselves, then it is not undervalued, it is misleading. The grocery store must stand on its own as an investment, separate from personal effort. If it cannot do that, it fails the value test. At this point, it becomes clear just how thin the line really is between valuing a small private business and valuing a large listed one. Strip away the ticker symbol, the analyst reports, the quarterly earnings calls, and the exercise is exactly the same. When you buy a share in a listed company, you are not buying a piece of paper that trades on an exchange. You're buying a fractional ownership interest in an operating business. That business has customers, employees, suppliers, costs, competitors, and cash flows. Precisely the same elements that exist in your local grocery store. The difference is scale, not substance. A listed company may have revenue that runs into billions rather than tens or hundreds of thousands. It may operate across continents instead of a single neighbourhood. But the underlying questions do not change. What does the business earn in a normal year? How reliable are those earnings? What assets are required to produce them? And how vulnerable are they to competition, mismanagement, or changes in the environment? In many ways, valuing a small private business makes these questions easier to answer. There are no adjusted earnings, no stock-based compensation buried in the footnotes, no one-time charges that seem to recur every year. Cash either shows up in the bank account or it doesn't. Inventory either turns over or it sits on the shelf. This is why Graham and Buffett insist that the intelligent investor think like a business owner, not a market participant. When you consider buying a grocery store, you instinctively focus on tangible realities. Yet when the same business is wrapped in the language of capital markets, investors often abandon that clarity. If you would not buy the entire grocery store at a given price, you should not buy a small piece of it either. Liquidity does not justify overpaying, and a stock exchange listing does not turn a poor business into a good one. Much market behaviour would look absurd if applied to private businesses. Buying simply because others are bidding the price up, paying more because something feels expensive for a reason, ignoring the fundamentals because the market has already priced it in. No rational buyer would behave in this way when acquiring a private business. Yet these habits are perfectly commonplace in public markets. Graham's genius was to insist that valuation should not change simply because a business is listed. Mr. Market may shout prices at you every day, but the underlying reality of the business remains the same. We now arrive at the heart of Graham's philosophy: margin of safety. In public markets, margin of safety means buying a stock well below conservative estimates of intrinsic value. In the purchase of a private business, it means assuming things will not go perfectly. It means allowing for lower sales, higher costs, and operational setbacks, and still finding the investment attractive. A value investor will assume modest decline before assuming growth. They assume competition before dominance. They assume mistakes will occur because mistakes always do. If the grocery store only works if everything goes right, then it is not a value investment. Margin of safety shows up most clearly in the price paid. Graham believed price determines risk. Paying too much for a good business can be just as dangerous as buying a weak one cheaply. Paying a conservative price provides room for error, learning, and the unexpected. Assets are another area where Graham's thinking becomes very concrete. Modern investing often downplays tangible assets in favour of narratives. He cared deeply about what a business owned and what it would be worth in a worst-case scenario. In a grocery store, this includes inventory, refrigeration, shelving, point-of-sale systems, and sometimes the building itself. Assets provide downside protection. They might not be exciting, but they matter. One reason grocery stores can still appeal to value investors is customer behaviour. Grocery shopping is habitual, demand is frequent and predictable. But predictability alone is not enough. The investor must understand why customers choose this store and whether that advantage is durable. Growth is not required. Benjamin Graham did not demand growth. He demanded adequacy. A business that produces steady, reliable cash with limited risk can be a perfectly acceptable investment, even if it never expands. Debt, however, must be treated with caution. Graham was deeply wary of leverage. Debt removes margin of safety by magnifying errors and reducing flexibility. If an investment only works under optimistic assumptions, it is not conservative enough. The purchase of private businesses also introduces emotion. Sellers tell stories, buyers imagine improvements. And Graham would warn that emotions are more dangerous here than in the stock market. The discipline to walk away is essential. After all the analysis, Graham would return to one final question. Is this clearly and demonstrably a good deal? Not could it become great, but is it cheap relative to conservative value? Is the downside limited? Is the return satisfactory even without being brilliant? If the answer is yes, he proceeds calmly. If not, he walks away without regret. Value investing was never about excitement. It was about rationality, discipline, and humility. Whether you're buying shares in a listed company or a small grocery store on a quiet street, the principles are just the same. Protect the downside, demand a margin of safety, and remember that the goal is not to be bold, but to avoid permanent loss while earning a reasonable return. And that, in a nutshell, is value investing, wherever the capital is deployed. And that is all for today's edition of Intelligent Investment Today. I do hope you've enjoyed considering the similarities between investing in a small mom-and-pop store and a multi-billion-dollar behemoth. If you have enjoyed the episode, please do consider subscribing or adding it to your playlist, so you never need miss a future edition. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.